So you do have access into so many consumer credit cards. What are you seeing? Are you seeing delinquencies go up?
You know, what I would say is we've been watching that very closely. We saw a little bit back in 2016. We tightened up a bit, and right now we're feeling pretty good about where the consumer is. I think, you know, one of the things we look at is their payment patterns, and, you know, consumers are paying their debt.
Are there any areas that have a little bit of weakness, or where would you be looking just to like double check?
Yeah, I think what we normally would look at, because you really want to look at and be prepared before you even see the delinquencies. And what we look at is things like minimum payment. Are they changing their payment behavior? So we have a lot of data on that, and we're really not seeing any indication of that. So we're feeling fairly confident about where the consumer is right now.
When you look at the overall numbers, you do see some indications, some banks are talking about this. Do you think that you just have a different set of customers, or are you taking actions yourself to sort of protect against the eventuality?
We've taken actions already. So I think we saw some movement and actually have tightened up a bit. So, you know, we're always looking every single day to make sure we're underwriting correctly. I mean, what we want to make sure we're doing is putting credit in the hands of the people who can afford to do it, right? So we have a lot of data, a lot of credit underwriting that we do, and machine learning that we use to really make sure we're underwriting the right way. And I would say right now we continue to see the consumer holding pretty strong.
And what about regionally? Are there any differences across the Rust Belt or service sector, manufacturing, or you have any patterns that's
we don't see any
revealing
patterns.
anything?
No. I think this gets back a little bit to, you know, the consumer is working. And I think this is a big factor of the strength, I think, of the overall economy, and I think we see it even in our business.
So we have jobs numbers coming out in like 15 minutes from right now. So how good news is it for you when you see wage growth, particularly real wage growth?
No, we think that's a good thing, wage growth, right? And I think we're seeing that, and I think that's holding the consumer together. You know, I think the consumer, I think overall, is continuing to be thoughtful about how they take on credit as well. And so I think, you know, while we've seen the increase in credit, I still think consumers are cautious and thoughtful about how they're paying back, when they pay back, and paying attention to their credit bureaus.
And would you say you become more aggressive in searching out customers at this point in the cycle, or are you less aggressive relative to, say, 1 or 2 years ago?
I don't think we ever get aggressive. I think we really play to our strength, which is we try to be as consistent we can in good and bad times. You know, one of the things that's important for us is we support retailers, and so it's really important for us. We're a big part of their sales, so we don't want to be increasing a lot, then pulling back a lot. We try to make sure we have a core set of customers we go after and deliver, because our goal is really to help our partners grow.
And is that in that context, does it matter with the retailers, brick and mortar relative to online, and are brick and mortar on a more structural challenged environment, and that could matter also for your numbers?
No, you know, I think the consumer is going to where they want to shop, whether that's online, mobile, or in store. You know, for us, we know that if they shop in store, so brick and mortar, and online, they're definitely a stronger brand customer for that retailer. So that's really, really important, and we look at that.
You mentioned artificial intelligence earlier, and I know you've been a big and early proponent of really using big data and technology. Can you actually manage your risk more effectively? Are you more confident, actually, because of the patterns you can follow through your big data, to know that you can actually loan more money because you know where it's going?
I think there's two pieces of that. I think, one, we have more data on the consumer, so we can look at both credit performance but also behavioral performance. Obviously, you showed that we have 80 million active credit card holders, so we can look at them across and see how they're performing across our portfolio. I think the other piece that's been really helpful for big data is really around fraud and patterns of fraud. And that's really where we've been able to use AI very effectively to really figure out, is that your mobile phone that you're shopping from, your iPad? Are you in store, out of store? Do you live in Connecticut, let's say, and are shopping somewhere in a different place? It doesn't make sense. So we look at patterns. That really has helped us a lot.
Do you have any sense on sort of hiring and wages from where you sit in terms of credit applications? Like we showed a great chart earlier that showed that higher end paying job wages haven't really been going anywhere, but like middle income and lower income wages have been moving higher. Do you have a read on that from where you sit?
No, we don't really look. We look at each customer individually. We don't try to make broad base. We have to really evaluate each customer on their own, and that's how we look at, do they have a job? Can they afford the credit that they're applying for? And, you know, are we confident they're going to make payments back?
Your business has been very dependent upon, relied upon loyalty cards as a practical matter. What does that business look like? Is that increasing? Is it decreasing as a matter of credit cards?
No, I think the big thing here is that our customers are really tied to the brand of the partner. And if they're loyal customers to that partner, they're most likely going to take out the credit card of that partner, because we're going to always give more rewards to that customer who's a consistent purchaser in that retailer than a general purpose credit card. And so, if we take someone like a TJ Maxx, they're very loyal customers. They love their credit card. They'd love to get their points. They'd love to go back in and shop. So the more loyal the customer is, the more likely they have our card, and it's kind of a virtuous circle of we tend to keep that customer loyal to that brand.
And very broadly speaking, have you seen any patterns in the differences between customers who are transactional, who basically pay back their balance every month, and the amount of customers who are revolving, meaning keep a balance and potentially grow that balance over time?
That's a little bit of what I was saying earlier. We do look at that. We have not seen a difference, but that would be something where we know someone traditionally paid off the whole balance, all of a sudden they're slowing their payment. That would be a signal, is something happening to that consumer, or is it more broadly? And those are the kind of things we watch. We're not really seeing any change in that.
And on balance sizes, I know this gets very broad, but on balance sizes, are they generally going up or generally down or roughly flat?
Roughly flat. Our business is a bit cyclical because obviously at the holiday people tend to spend more, then they pay down, then they go back up.
The Federal Reserve, through Mr. Powell, appears to be saying we're not raising rates, we're not cutting rates, not doing anything. What does that mean for your business?
We try to stay rate insensitive, so we try to manage our balance sheet that way. So, we manage it that way, so it's not really a big deal for us.